Alright class, we're going to go ahead and start with Chapter 11, preparing a worksheet for a merchandise company. Now the major takeaway that we're going to start with for this class is dealing with merchandise itself. Now the book's going to be talking about beginning inventory and ending inventory. Now beginning merchandise inventory will always be the number you started out with when you began your business, whatever month you started. So in the example for 11B3 for your assignments, it's going to be the example of $5,182. Now, the one thing is that the book does is that it gives you the knowledge of how to calculate from beginning to ending inventory for the accounting equation and the worksheet as a whole if you were to be running a merchandise company. Now, the way you process everything is you're going to be basically starting off with your beginning inventory, and then after every certain period, whether it be a month, quarter, semi-monthly, however you run your merchandise inventory, you're going to always take the total of whatever you have in your inventory that you had left and then basically subtract that from what you started out with. Now, the best example that they have here is going to show the beginning inventory is $19,000. Now, during the period of that 1 month that they were working, we're going to give for an example, is that they purchased nearly over $50,000 in purchases. And now purchases are the same thing as merchandise inventory. It's just that purchases during a period are going to be labeled under the purchases account. They won't be transferred into merchandise inventory until the next cycle or the next month after you've done all the calculations. But beginning inventory plus anything that you bought or purchased from a vendor would then be added up together to show the total amount of what you had to sell to your business, like through your business to your customers. It would be known as the cost of goods available for sale, meaning that you purchase stuff from a vendor in order to resell it for a profit. Now, after every certain period, you're going to figure out how much value you have left in your inventory. Now, the example they give here in the PowerPoint is that $4,000 left out of your initial $19,000 plus anything that you had purchased during that month. So you sold a total amount of $65,910 worth of merchandise through your company. So that's a pretty good sale if you think about it. It's pretty good sales. Now, this little asterisk here that they had on the net cost of purchases, meaning that this raw number of $50,910 is after they've done the purchase discount and after the purchase return and allowance and any freight in. Now, just a reminder, what purchase discount is that when you pay off your debts to the vendor, that amount shows how much money you saved when you paid off early based on the net terms or the agreements between you and the vendor. So again, a net term is going to be dealing with what, like a discount honor that the business gave you. So if they gave you 10% discount if you pay within the first 15 days, and you do that, they'll give you a percentage off of whatever amount that you bought from them. And now purchase returns and allowances is going to be whatever you returned to that business or to that vendor that was defective or you just didn't need it anymore. And then freight in is going to be just basically an expense or showing that money that you used to get that merchandise to your business so you could resell it. Now, if I give an example on how to do the adjustment for the beginning inventory. Now, if you look at the picture, I'm going to show the picture here on the screen for you, but it's going to be sideways, so you can yell at Klaus for that. It's the initial transaction is going to be for ending merchandise inventory on December 31st, $1,835. Now, the way you would initially show this is you're going to first going to have to get rid of your beginning inventory. You have to take that out of that account first. You always have to do that first. So what you would do is you're going to then debit. Ignore the adjustments pieces just to show. You're going to debit that whole amount of $5,000 $182 into income summary, and then credit it out of that merchandise inventory. Now you're probably wondering why you're seeing income summary inside the worksheet. Now the reason why it's in there is only because it needs to help. It helps balance out the worksheet itself and to show the adjustment of merchandise inventory for this chapter. So don't stress out just because income summary is there. Now, for y'all that don't remember what income summary is basically just a holding cell or a holding account for the values of the amounts within your business. So for this case, it's only to show the transition between your beginning inventory and your ending inventory, to show what you started out with and now what you're ending with for the next month. So in this case, we're ending the month of December 31st. So in the beginning of the month, we had $5,182, but now we only have, as the book says, we only have $1,835 left. So we're showing that we're taking out that initial value that we started out with, and now we're ending with the $1,835. And then you're going to debit that into merchandise inventory to show that that is what you have now. This number here is what you will now have for the next month coming over into January 1st. And for every debit, there's always going to be a credit. So you're going to have to then credit income summary for the $1,835. Now remember, this is just to show that transition from your beginning number of $1,500 of the $5,000 to the $1,800 amount. Okay, it's only just to show that. Now, the other accounts that you're going the other adjustments you're going to be dealing with here is just basically some of the stuff that we've already done before in the beginning of this class, which is the next one is going to be office supplies used up for $210. Now initially, before they would say office supplies on hand, meaning that that's how much you had left. But for this transaction, it's showing that office supplies used up for $210. So you've used up or gotten rid of $210 worth of your supplies. So you're going to have to look for office supplies. That's one account that we have. And the other account that we're going to need to probably add is then office supplies expense. And the reason why office supplies expense is because when you use up an asset like office supplies, it will then be shown to be getting rid of through office supplies expense, showing that, remember, an expense shows money leaving your business. So we used up $210. This is transaction C, $210. That's the debit for expenses. Now, initially we started with $988 with our office supplies. So then we're going to credit or subtract that $210 that we used up from that number and then put it into this adjusted trial balance later on. But we're not done yet with our adjustments. Always finish through with all your adjustments before doing any number transfers. Now, the next basic transaction that we've done before is rent expired, which basically means you've used up rent. So if you look at one of your accounts, you have prepaid rent. This is to show, prepaid rent is to show how much money you have in advance for your business, wherever you're basically renting out your merchandise company. Now we have one account, which is our asset account, which is prepaid rent. We have to look through our accounts here, and if we do not have the rent expense account, we're going to have to add it here at the bottom. So we don't have it here, so we're going to have to add it down here, rent expense. Now since we've used up or rent has expired for the month, we have to show a debit increase of $195 for rent expense. Now since we're using up what we've initially had for an advance, it is now time for it to depart from our account to the vendor. to our tenant or whoever we're renting from, and we're going to credit or subtract $195 from that initial account to show that we've decreased within that account. Now, our next one is going to be depreciation expense on office equipment. Now, depreciation is just showing the amount of devaluement for whatever asset that you're using, whether it be a car, a truck, a computer, or just basic office equipment, like a printer. So in this case, we're going to show that devaluement of that. So we have accumulated depreciation office equipment. That one is going to be our credit, because that's a contra asset account. Remember, a contra asset account goes against whatever initial value you had for that account. So we need to always work with our debits first. So we don't have a debit already placed out for us for this certain transaction. So we have to put depreciation expense office equipment. And then you're going to debit that for the amount of $525. And then again, we're going to, for every debit there's a credit, so you're going to have to then credit accumulated depreciation for the specific office equipment for that amount. And finally, we have office salaries earned but not paid for $270. So this basically means that it's time to basically pay your employees, your secretary, whoever you have in your business, your clerks or your stock people, but you just have not paid them. And now another word for that we learned before was accrued salaries for your employees. And that just basically means the same thing as what this is: office salaries earned but not paid. So if we look through our accounts, we have one that says office salaries expense, which is our debit. So we're going to start with that one now. So transaction F for $270 debited. And since we're not paying this off right away, we're not paying it off right now, we have to show that we still owe that money to our employees. So that's going to be office salaries payable, because remember, payables are liabilities or what we owe to whoever, employees, vendors, your mom, Dr. Claus, whatever, for $270. And now the one way to check to see if you're doing everything right is if you take this credit and balance everything out down here and do the same thing. Oh, what happened there? And do the same thing for the debit side, you should come up with the same equal value of total. Let me put total here first. Get this. Oops. You should come out with a total of $8,217 on both sides. Oops, excuse me. $217 for both the sides. Now, I kind of want to stop right here real quick on the worksheet and go back to the PowerPoint to show y'all one thing that might be on the other assignment on 11A3. And now 11A3 might have an adjustment of showing unearned revenue. Now, unearned revenue is basically when you're basically renting out a part of an area of your business, or maybe you just have a separate building that you own and you're renting it out to somebody else, third party, and they pay you in advance for the rent. And now what that means is that they gave you all the money, so you basically earned that money. You have that money in there that's saying that you've earned it, or that's money that's in your accounts, but you haven't necessarily earned that money yet, because that rentee, whoever's renting from you, can come back and say, hey, you know what, I may have paid you 4 months in advance, but I'm only going to pay this month's rent, and then I'm going to be leaving. So you still have to give back the other 3 months' rent to them, because you haven't earned that money. You can't just keep that money just because they gave it to you. So it would be considered a liability or something that you owe to them until the time comes where the rent is due, and then you actually, quote unquote, earn the money and you have it transferred from a liability to your checking account or an asset account. So again, unearned revenue would be a liability showing that you haven't earned that money yet. And the best example that the book gives you is that being paid in advance to you from a customer or a renter. And the rest of it is basically just what we've already gone over before. So I don't think we need to go into that anymore out of the PowerPoint. So I'll just continue on with the worksheet of 11B3. Now, since you have your adjustments already processed here, you then have to transfer from the trial balance numbers with your adjustments into the new adjusted trial balance for the worksheet. Now, if you notice that cash doesn't have any adjustments with them, there wasn't any adjustments for this month. So what you do is just transfer that number over right across. $5,372. You're going to do that for all the accounts that don't have any adjustment numbers. There weren't any adjustments for this month. You'll just bring those numbers right over. Now, for merchandise inventory, we've already talked about how we first started out with the $5,000, but now we're ending with the $1,835. So you know that you're going to then put $1,835 because the transaction in the assignment for A/B told you that that's how much that you need, that you're left off with for the end of the month. And then you just keep continuing on for the rest of the amounts. Prepaid rent, $616 minus $195 will then come out to $421. Continuing on, office supplies, $210 minus the $988, giving you $778. Danny, can you get this for me, please? Sorry about that, y'all. You just keep going on with the assignments of what's going on. Office equipment, it's just the regular value of $9,410. Accumulated depreciation, now it's a credit and a credit. So when there's a credit and a credit, guys, or a debit and debit, if they're matching sides, matching rules, you're then going to add them together. So for $7,200 plus that $525, you're then going to have, I believe, $7,725. Yes, $7,725, but on the credit side. $7,725 on the credit side. Accounts payable, we didn't do anything with that, so we just transfer that number right over. Capital, same thing. Didn't do a thing with it, so we just keep going with it. Withdrawals, same thing. $4,800, just keep it going. And now, for the income summary that's highlighted, you're going to bring those whole numbers over, both numbers over. You have to bring both of those numbers over in order for everything to balance out right in the worksheet. It just has to happen, okay? You have to do that. It's just a rule that they have for this chapter and for the next chapter, for chapter 12, the final chapter. Now, we don't have anything working. We didn't do anything from sales to purchase returns and allowances. So what we could do is we could just go ahead and copy these numbers right over and have that there. Now, for office salaries expense, we have a debit and a debit. So we're gonna add this number, $7,616, with $270. So that'll equal out to, I can't do math here, so please bear with me. $788.06. Insurance expense, along with basically the rest of them down here, they don't have any combining accounts that we have to do any math with. So we can just go ahead and copy and paste these to make our lives a lot simpler. Just be sure you're doing it in the right area and so you can transfer it in correctly. Okay? You gotta just be sure that copy, and it's going to be pasted right there. Now, if you do these totals, and let me just double check my numbers real quick to be sure I have everything correct. Yes, your numbers should balance out to $74,364.00 for both of the sides. 74,364.00, and then you now have your adjusted trial balance. Now, a quick, kind of like a cheat sheet kind of thing, not really, for the income statement. Remember, the income statement deals with only your revenue minus your expenses. Now, income summary is going to be included into this, and it will only be included here in the worksheet at the income summary. It'll only end right here. You won't bring it over into the balance sheet after that. So one dead giveaway for y'all is that from income summary down to your last expense, all those numbers should be transferable over into this portion of the worksheet of the income summary. The income statement. Because it shows all your revenues or your credits of how much money you've earned or have versus how much money you've used up, which is all your debits of expenses or what has left the business. So then you're going to do the subtotals of these debits and credits. So for the debit side of the income statement, you should come out with $49,129.00. For the credit side, you should come out with $54,864. Now what you have to do here is you have to take the difference between these two numbers in order to determine if you have a net income or a net loss. Now, to figure out, to know that if you're getting a net income or if you have a net income, is if your credit side is greater than your debit side, because your credit side shows the money that you've earned, money that you've earned, whereas the debit side shows how much money you've used up or has left the business. So if your credits are greater than your debits on the income statement, you know you've made some money. So then when you subtract these two numbers, you're then going to get $5,735 for your net income. Now, one thing to note, like what I just said right now with the income statement, if your expenses or your debits are greater than your credits on the income statement, you will then have a net loss. That's one thing to keep in mind for Chapter 11 in your review concept questions, okay? Just letting you all know about that. Feel free to rewind right now. Now, you're going to balance out to that number of $54,864. Okay? Should balance out to that just fine. And now, basically, everything else that's going to be on the balance sheet will be what you have above the yellow line of income summary. All those numbers will come over to this side, paste with the numbers. But don't forget, there's one thing that you may have overlooked, or may have actually accidentally added into your income statement, which may throw some of your numbers off. And that is the final adjustment that we did, which was office salaries payable. Now that account needs to be also included in your balance sheet. So that $270 needs to come over in order for things to balance out, or for your numbers to be correct. I've had a lot of students get real hasty and try and copy and paste like I showed y'all earlier, but they'll just go one more cell too much, and take the office salaries payable into their income statement, which throws off their net income and will then throw everything else off after that. And then they just wonder why they can't balance. So you have to be very careful and take a look at that. You have to be sure that you know all these accounts that you're highlighting, copying and pasting into other areas are the right accounts. Because if you take that salaries payable and you throw it in there, it's going to throw everything off, and you're not going to understand why your numbers aren't balancing. And you're going to be calling Dr. Claus on the weekends, and she's going to be pulling her hair out and then wringing my neck on Monday morning. Okay? We don't want that. Now, in addition, you're not going to balance out on your balance sheet on the worksheet yet when you get to here. You're going to have a smaller number on the credit side because the worksheet requires you to move your net income over into that balance sheet as well. And once you do that, both your debits and credits on the worksheet balance sheet should balance. So if you take these numbers and you add them together for your debit side, you should come out with a number of $25,235. And then on your credit side, if you take these numbers and add those together, you should get up a number of $19,500. Now, this is where I'm showing you where you're going to be short before, just with these numbers, because the worksheet requires you just to bring this number over, this net income number that you got out of income statement, over into your balance sheet. Now, a quick refresher on why that happens is because every single financial statement needs each other. The income statement lives because the statement of owner's equity needs it. The balance sheet lives only because the statement of owner's equity is needed because of them. So you need, once you calculate something out of the income statement, that number needs to go over to the statement of owner's equity. Whatever happens in the statement of owner's equity needs to go over to the balance sheet in order for everything to be updated. Now, the reason why you don't see the statement of owner's equity inside, in between here and the income statement and balance sheet, is because it's not really needed for the case of just trying to figure out your numbers to see if they're right. You only use all three of those if you're doing the formal reports to show business executives, or to show Uncle Sam of the IRS that you're doing things right and square. That's the only reason why they have all three of those formal statements in there. For the worksheet, it's not that bad. They don't need the statement of owner's equity in there because you already know. They're basically just wanting to find the numbers right, that your numbers are correct. So if you do these balances here, you should get a good balance of $25,235. And that is it for this assignment. Now, anything else that I think you need to know is nothing else. Now, the one thing is that's going to get more strenuous when it comes to Chapter 12 is that it's going to go through the whole process of the accounting cycle. You're going to start from the beginning of journal entries, transferring them to the ledgers, working on your worksheet, and then working on all those formal financial statements of the income statement, the statement of owner's equity, and finally the balance sheet. They're even going to probably throw in a couple of payroll transactions in there, maybe not. I haven't looked into it yet. I'm going to do chapter 12 video right now, right after this video. So I'll let y'all know on that one. So this is the basics on your takeaways on what you need for chapter 11. Basically a refresher. It's the worksheet. Nothing really new. The only thing that's new is that the income summary is inside the worksheets. And you already know, again, is that it's only a holding cell to show the transfer of your beginning inventory to your ending inventory for the next month. So you can keep going with your system. Okay? So bear with me. I'm going to get the next video done.